أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. So we have chapter 8. It's a fairly simple chapter, just one particular item we're dealing with in chapter 8, which is receivables. And inshallah we perhaps can finish in about an hour, given how many questions you have, and then we can take a short break and start the computerized accounting test, inshallah. So we have different types of receivables that we're going to address. We have accounts receivable, we have notes receivable, and we have other types of receivables, and we're going to discuss some details about these different types of receivables. The accounts receivables are from customers. So you sell, when the business sells to customers, mind you, these are other businesses. So most of the time, the customer of a business that has an accounts receivable is also another business. So for example, Al Rayyan Water Company has an accounts receivable from Carrefour. It has an accounts receivable from Lulu. It has an accounts receivable from Almira, right? And you go to Carrefour, or you go to Lulu, you buy and you pay with cash. So these are accounts receivable for individual customers, for the most part, right? So it's one business buying from another, and this is called, that's why this is called also trade accounts receivable, trade, right? T-R-A-D-E, trade accounts receivable. And then you have the second types of receivable, which is called notes receivable. Notes receivables are long-term receivables, which are received over a period of time, right? It's received over a period of time, and this usually has a payment schedule and a fixed amount of payment, right? And it's paid over a period of time, okay? Now, Ismail, what are you working on? Huh? Something in my class? Somebody else's class? If it is somebody else's class, you're cheating me. You're cheating yourself, right? Very good. Now, notes receivable, we're going to talk about a little bit. It is fairly simple. There's not a lot of accounting treatment that has a lot of variations per se. Fairly simple. You make a monthly payment until it's totally paid off. And then anything that is not an accounts receivable or a notes receivable, it's other receivable, right? It could be loan from officers, it could be advances to employees that are receivable, income taxes, right? If you're a government entity, income tax refund if you're a taxpayer. So anything else that you cannot put in accounts receivable or notes receivable, it will be classified as other receivables, okay? And we're going to focus heavily on accounts receivable, the treatment of accounts receivable. Advances to employees. I'll give you an example from our university. When a new employee comes, a new employee joins the university from outside, the moment they arrive, the university gives them 1 month's salary in advance. Okay, so this is now before the employee has done the work. So this is a receivable from the employee. And this advance, so let's say the employee is making 20,000 riyals per month. This advance is deducted from the employee's paycheck over the 3 months, the first 3 months. So every month, 6,666 riyals will be taken back from the salary. So the first 3 months, the employee is only going to get about 14,000 riyals, adjusting that receivable. So this is a receivable due from the employee. A university also extends a loan, which is to buy a car. So anybody coming from outside. So again, this is a receivable which is paid back over 3 years, right? So this is a large amount because it's, you know, obviously you cannot buy a car with 20, well, you can, but the university gives you a larger amount, so you get it back. They pay you back over 3 years. So these are examples of advanced employee advances, right? Trade receivable is accounts receivable. This is non-trade. Okay, so also called trade receivable. Notes receivables are actually not called trade receivables. Well, they could be called, but this is trade accounts receivable, right? The accounts receivable is called trade accounts receivable. Notes receivables are called trade receivables in those few instances when you are in the business of loaning, right? We're in the business of loaning. But again, this is not something that is common, and the bankers can confirm that. Have you ever heard of something called trade receivable? Right? You have heard of notes payable, notes receivable, because this is the term. Trade receivable is something that's a bizarre, you know, term. I actually forgot about it. This is something like this because it's not used in the industry. You know, when I took the CPA exam, I'm sure I studied it back in '99, 21 years ago. But this is just such an uncommon term that I've never used even once. I remember using this during my practice. Follow? So it's just strange. It's not very common, right? At least the industries that I've dealt with. Now you might find in the coal mining industry, notes trade receivable is very common. It could be, right? Okay, now there are two accounting issues here with the accounts receivable. First is recognizing the accounts receivable, and the second is valuing the accounts receivable. Recognizing the accounts receivable meaning that you realize that how much accounts receivable you have from your customers, and then you assign the true value of what you are actually going to get, right? Because some accounts receivables are not going to be collected, right? Some accounts receivables are not going to be collected, and we're going to talk about these two, recognition and valuation, in detail. There are two types of organizations that deal with accounts receivable mostly. One is a service organization. A service organization is someone that provides a service, and as soon as they complete the service, an accounts receivable is due from the customer if the customer does not pay immediately. So if you have, for example, cleaning services or gardening services or security services or any accounting service, law service, anytime you provide the service, as soon as you're done with the service, the customer does not pay immediately, you have an accounts receivable created at that time, right? At that moment, the accounts receivable is recognized, meaning there is an accounts receivable. You have provided the service, so you have revenue, and then you have an asset that is due to you. Merchandiser, on the other hand, are those companies that sell goods. So let me add one more thing here. It could also be manufacturer. So not only merchandiser, but it also could be manufacturer. So, for example, Al Rayyan water bottling company is a manufacturer, categorized as a manufacturer. Baladna is categorized as a manufacturer, right? They have a manufacturing plant. They bottle items, they produce milk, and they have juice and other things that they do. So they manufacture goods. They also have accounts receivable from the companies that they sell to. Okay, merchandisers are businesses that buy goods and they sell goods, right? Finished goods. They buy finished goods and they sell finished goods, right? Does it make sense? You with me? Okay. All right. You can stop me and ask me anytime. let me move forward. So let's take a look at an example here. Assume that Jordan Company on July 1, 2014 sells merchandise on account to Polo Company for $1,000. The terms of sale are 210 and 30. Prepare the journal entry to record this transaction. So as soon as it's sold on July 1st, the date of the entry is going to be July 1st. Sales revenue 1,000, accounts receivable 1,000. This is something that is a piece of cake for you. You have entered this entry many times, right? This is, you already know what this means, where it goes. Accounts receivable goes in which financial statement? Accounts receivable goes in balance sheet. In which section of the balance sheet does it go? Current asset. Excellent. The sales revenue, where does it go? Income statement. Where does it go on the income statement? First line, right? This is the first line, right? First line of the income statement, right? Very good. Yes. Right. The 210 and 30, we're going to discuss. What does this mean? We did discuss this a little bit before. 210 means you get 2% discount if you pay within 10 days. Right? We addressed this a little bit, but we're going to clarify it even more. It will become even more clear to you. We touched on it before. Yeah, yes. 210 means if you pay within 10 days, you get a 2% discount. You don't have to pay the whole $1,000. And if you pay within 30 days, then you have to pay the whole amount, right? What happens if you don't pay within 30 days? We'll discuss. There are multiple things that happens when you are not paying after 30 days. Okay. Now, on July 5th, the Polo Company, who is the buyer, returns $100 worth of merchandise. So they return some items. What the seller is going to report is as follows: sales returns and allowances as a debit, and accounts receivable as a credit. Accounts receivable is reduced by 100, and sales returns and allowance. Notice sales is not reduced. Sales returns and allowances are reduced, right? You remember this account? Remember what we call this account? Contra? Contra what? Contra part is right. Contra what? What does it come under? It is making something, it is contradicting something. Yes, but what is sales? It's called contra revenue. Contra revenue, right? Contra sales is also correct. Contra revenue. Anything that reduces the revenue, it's not an expense, right? Why do we keep track of it separately? Because we want to see how many customers are returning, right? What is it? What is the percentage of returns based on sales? And you're going to see in the financial statements that you're studying, right? You see this item, sales allowance, sales returns, right? Sales returns and allowances. Sales returns are items that are returned. Sales allowances are discounts that are given because the customer may have received a damaged item or something that they did not exactly order. Okay? I cannot understand it. That is right. We are now, you will, if you get into this, you will confuse yourself and everybody else. Here, what we are going to do is we are going to approach the accounts receivable on the side, from the side of the seller. Right? We're going to, accounts receivable belongs to the seller. Accounts payable belongs to the buyer, right? So one man's accounts receivable is another man's accounts payable, right? One company's accounts receivable is another company's accounts payable. Okay. So we have on June 11th, the company, the seller receives the payment, right, for the amount due. So when you see this, that means now what is due from the customer is 900, right? Are they within the 10 days? Yes, they sold on the 1st, they're paying on the 11th, so they're still the last day of getting the discount. So they will get a 2% discount. They will only pay 808 riyals in cash, right? And the sales discount of 18 riyal or $18 would be recorded. So the credit is going to be accounts receivable, and the debit is cash 882, and the sales discount 18. Right? You remember we did this before? Do you remember? Yes, vaguely. Okay, it's okay. I mean, you don't have to remember that. We're studying from the scratch. So 2% of 900 is 18. So they're not going to pay the whole amount. They're going to pay the 882, but the accounts receivable must be reduced for the whole amount, right? Accounts receivable must be reduced for 900 because there is no more accounts receivable once they have paid 882. So you wipe out the accounts receivable, but you only get 882 in cash. So where do you difference? $18 in sales discount. Sales discount goes in which statement? Income statement. Where does it go? Under sales. What type of account is this? It's contra revenue. It's contra revenue. Anything that reduces the revenue is contra revenue. Anything that contradicts the revenue, right? Anything that contradicts the revenue is contra revenue, right? And usually any account that starts with sales and then something else, it's a contra revenue account. Okay? For example, if you have sales discount or sales returns or sales allowance, all of those are contra revenue. Now, when I say something else, for example, if it says sales food, sales drink, sales candy, sales ice cream, or they're all revenue accounts. They're different types of sales. As you will see, sales delivery, sales pickup in the financial statements, different types of sales. This number on the financial statement is going to be in the parentheses, right? The contra is always in a parentheses below the sales, right? Okay.
Making the generalization entry, how do you enter these values? The generalization entry.
This is the journal entry. Right. What happens? Tell me what did we do to sales discount? This is a journal entry, right? So what did we debit and what did we credit? What happens to sales discount? Where did we do it? Where did we put it? Look, the journal entry, the system of recording the journal entry is the debit is on the right side, the credit is on the, sorry, the debit is on the left side and the credit is on the right side, right? So what did we do to the sales discount? Did we debit or credit it? Debit, right? Debit must equal credit, right? If this is 900 on one side, 900 on the other side, right? Yes? You're scaring me because this is basic information from 5 weeks ago or 7 weeks ago, right? Yes. Don't do the buyers. Don't do the buyers. Don't go to the buyers. Right? We don't care what the buyer is doing. We don't care what the buyer is doing. We are not handling the account of the buyer. We are not in the buyer's side. You follow? If you do this, it becomes extremely confusing. We are on the seller's side. We have accounts receivable. We are only dealing with the seller. So you will never be an accountant for both sides. Follow? You only worry about one side, which is the buyer. You cannot work for Baladna and you at the same time. So you handle Baladna's account when Baladna is a buyer and we are in the accounts payable section. Right? So when we are here, we are dealing with the seller. We only want to deal with what is debited and credited by the seller. So this is double complication. You have to think about what the other guy is doing, right? The accounting becomes very complicated. You don't want to complicate more than what you have. All expenses are derivative. It's sort of an expense. It's all the opposite derivative, right? So again, let's go back. Normal balance. Something called normal balance, right? How many accounts have a normal credit balance? Two. They are assets and expenses. Excellent, outstanding. How many accounts have a normal credit balance? They are liability, revenue, and anything that is opposite of any one of these accounts will have an opposite normal balance. For example, sales is a revenue account. Normal balance is contra revenue. Opposite of revenue, then the normal balance is going to be of course it matters. Right? Normal balance means what? When it increases, you go towards the normal balance. When it decreases, you go towards the opposite of the normal balance. Let's go back to cash. What is normal balance in cash? What happens when you increase in cash? What happens when you decrease in cash? Opposite. So what are the normal balances? When the account increases, you go towards debit. The normal balance is debit. If it decreases, you go to debit. Every account works on that. Right? Every account works on that. So any account, if it decreases or increases, it goes towards the normal balance when it increases. It goes towards the opposite when it decreases. Right? Now, and your question is, can the discount ever decrease? Can it ever decrease? Anything can increase and decrease because we have something called adjusting entries, which are used to adjust that which is not correct. Okay? Remember adjusting entries? Say that again? Yeah, $10, okay? Right. So if it if for any reason you have to decrease the discount or it change, anytime the discount decreases, you have to go the other way. It will have to be credited. Under what circumstances and situations can it happen? There are many, right? But again, if you get stuck in one account and discuss all possibilities, I can stay until Fajr, no problem. You know what I'm saying?
The cash is an asset for the buyer and asset. The sales is not.
Never say buy and you say no.
It's Contra Revenue for the seller and
How does it happen to the buyer? Remember, in the buyer's account, remember we have to talk about the buyer. The buyer's case, this is called a purchase. If it is a purchase account, it is handled depending on whether you use periodic or system or manual, periodic, manual. Let's discuss. You follow what I'm saying? So you get to this issue and you cannot deal with the buyer. You have to deal with them. Later, we will come to the buyer when we do. I have to edit this part of the video before I get posted. It's okay. Now, valuing accounts receivable. Your questions, Mr. Muhammad, gives me the feeling that you actually understand the details, so which is very good, right? And it is, while it's good, sometimes it can hold you back from progressing because you understand, your understanding is too deep and you venture out. You follow what I'm saying? It's good, right? It will be useful for you, inshallah, when you're a professional. We have to stay focused on the account that we're discussing because there is a lot of details in the account, right? So we are in the 7th of the 45 slides. Let's move. Valuing accounts receivable, we have, this is a current asset, which means we will get the accounts receivable collected within a year, within 12 months from the balance sheet date. And there is a net realizable value. Just because you have $1 million in accounts receivable, mean that you're going to collect $1 million. There are going to be some customers who are not going to pay. Either they went out of business, or they don't have money, or their business is slow. For whatever reason, they're not going to pay. And the uncollectible accounts receivable is a big account to discuss. So sales on account raise the possibility of accounts not being collected. Seller records losses that result from extending credit as bad debt expense. So we have the reporting of the accounts receivable that are not collected, that have a possibility of not being collected. And this is reported as a bad debt expense. And there are two different methods, two different treatments of dealing with it. The first one is called direct write-off method, and the second one is called allowance method. The direct write-off method is when you are certain that this particular customer is not going to pay, and you have tried to collect from that customer many times, and you are now sure that the customer is not going to pay, you report one entry and you entry of your accounts receivable. Okay? This is something that is not allowed under generally accepted accounting principle. And it also does not represent the true picture of the accounts receivable. So if you have $1 million in accounts receivable, and you know that 10% of this is not collected, usually your business is such that 10% of your customers end up not paying, let's say, right? But you still report 1 million in accounts receivable. That means this is just not representing, it is not representing the true value of the accounts receivable, right? Writing off the direct accounts receivable after you could not collect at a later period, right, is not allowed because you have to record the possibility of uncollectibility way before it happens. And that's the allowance method, right? So the allowance method is what is required by the generally accepted accounting principles. And we're going to discuss both of these methods, exactly what is the process step by step, each step at a time, and follow along. We're going to start with the two accounts. So here we have, under the allowance method, we have two accounts. One is the accounts receivable, which is $500, and the other one is allowance for doubtful accounts, 25. Now, allowance for doubtful account is a contra asset account. It's a contra asset account. Allowance for doubtful account is a contra asset account. It has an opposite normal balance from an asset, and it reduces the asset accounts receivable. So if we go back to the balance sheet, this is how it appears. Accounts receivable less allowance, and you have the net accounts receivable, which is 475. If you go back to the T accounts, accounts receivable will have 500 debit, and allowance for accounts receivable, allowance for doubtful accounts will have a 25 credit. So the net is 475. You can present this information in the balance sheet. This is one way. The second way of presenting it in the balance sheet is this: accounts receivable net of 25, so you don't show the allowance account separately. Now, we are still in the allowance method, right? The direct write-off method does not have an account called allowance for doubtful accounts. The direct write-off method is not allowed by generally accepted accounting principles, and some company may use that for internal purposes, right? And we're going to look at exactly how they do. It's very simple. It's one step. We're going to look at that. But our focus is on the allowance method. So this is what we have. The second method of presentation, if you're using the allowance for doubtful accounts, which is the allowance method. So far, so good? Clear? Okay. Now we go to next step. The company makes a sale for $100. So the entry to record that would be debit to accounts receivable and credit to sales. So what we do, the accounts receivable account, what are we going to do to accounts receivable? We're going to add $100 in debit, right? Are you following? The entry to do this is the entry, right? Debit to accounts receivable. Remember, we have credit to sales. We are not worried about sales right now. We are only worried about accounts receivable and doubtful allowance for doubtful accounts. So what happens to those two accounts on the balance sheet? Accounts receivable is debited. Allowance for doubtful account is credited on the financial statements. Accounts receivable appears as a number, positive number. Allowance appears as a negative number. So when we sell more, we add $100 to accounts receivable debit, right? You have all done the T accounts, you know, you just worry about that one account when you're dealing with the T account, right? Are you following? Okay. Then what happens? The customer makes a payment, right? So we get a payment of $333 from one of the customers for a previous accounts receivable, right? So we will debit cash and we're going to credit accounts receivable. That means in this T account, what will happen? A credit of 333 is going to show up. Are you following? Right? So the net balance again is 265, right? All of you know how to do this. Add the debits, add the credits, subtract, and whichever is higher, you go to that side, right? You have done it many times. Okay, so far so good. You're following? Then you have the next, which is an adjustment for $15 is estimated for bad debt. Now, once you come to this situation, we have $267 in accounts receivable, and we make an estimate. There are methods of doing this estimate based on past history, based on what you collected in the past years, right? So you make an estimate that out of this 267, you are not going to collect $15. Which customer you don't have to identify, right? You don't have to identify which customer. You just identify that out of 267, about $15 we don't collect. Okay? This is usually done based on a percentage calculation, industry norm, past history, all of these things. So you have some experience that your company will not collect $15. So what do you do? In the allowance method, you record a bad debt expense of $15, which goes in the income statement, right? You record a bad debt expense. That means $15 you could not collect, and then you record, or could not collect, not necessarily it already happened. Follow, right? This expense is a non-cash item. You following? This is a non-cash item. You are recording an expense because you think this is going to be an expense. This is called, in accounting terminology, conservatism. Conservatism, you are conservative. You want to give the bad news early, and you want to withhold the good news until the last moment, right? And generally, we are usually like that. So for example, if you have an exam, take an exam, and the exam was horrible. Somebody asks, how was the exam? Let it out. You say, go away. I failed. You follow. You get the bad news out very quickly. Let's just say the exam was super, right? Someone asks you, say, inshallah, let's see, I tried, You follow. You don't say, oh, I'll get 100. No question about it. Nobody does that. You follow what I'm saying, right? So you withhold the good news. Of course, when the results are out, okay, you can say I made 100. Follow. But usually, we withhold good news and we give the bad news early. You follow, right? So accounting treatment is the same. If it's bad news, give early. Okay? So what happens? The allowance for doubtful account is increased by $15. So this is how the allowance for doubtful account gets increased. And the allowance for doubtful account is periodically adjusted. It's adjusted based on what is collected and what is certainly not going to be collected, right? It's adjusted based on that, and it's also adjusted based on what you think is not going to be collected. And what I just said, I will demonstrate to you. It's a little bit confusing. I will demonstrate to you what I mean by that. So let's continue. We have here something called write-off of uncollectible, now of $10. Now you see, we have 267 as accounts receivable, and we have 40 as allowance for doubtful accounts. Allowance for doubtful account means I suspect that I'm not going to collect. You do not receive your accounts receivable directly. You reduce it with an allowance account that maybe I'm not going to count. I have allowance that I'm going to collect. But here we are sure that $10 of this doubtful is never going to be collected. So once you become sure, you make an adjusting entry between the accounts receivable account and the allowance for doubtful account. So it's no longer doubtful. You move it from doubtful to reducing the accounts receivable for sure. So with certainty, you reduce the accounts receivable directly. So you move $10 from this account to that account, right? So once it's no longer doubtful, you debit allowance for doubtful account because it's no longer doubtful, so you reduce doubtful by 10. It is certain that you're not going to collect, so you credit accounts receivable, right? So now your accounts receivable is 257, no longer 267, because before you thought, okay, out of 267, I might not collect 40, but now you are sure that this 10 you're not going to collect, so you reduce accounts receivable, you move that from doubtful to accounts receivable. So now you say my accounts receivable is 257, and of that, I think 30 I'm not going to collect. So this is called write-off of accounts receivable. The first entry when you report the allowance, you have doubt, maybe, maybe not. Right? When you write off, that means you are sure. So you are sure that you're not going to. And it's a little bit heavy, do you understand? Yeah? Okay. Okay, now we have, so here, this is the presentation, net of $30, 127. We have gone through this already. The next is the direct write-off method, where assume that this company has $200 balance as uncollectible. So what you do is there is no involvement of doubtful accounts. Doubtful accounts are no longer there. You debit that expense and you credit accounts receivable. End of story.
There is no contra asset account in this. There is no contra asset account.
There is no contra asset. Nothing. This is after you are sure that you're not going to collect, debit that expense, credit accounts receivable. Right? It's not allowed because it does not give a bad news for you. Right? There is no doubtful account in the direct write-off method. This is another method. Right? The first one we did was allowance method, where the allowance for doubtful account is involved. In the direct write-off method, there is no doubtful account. Right? It directly goes to the bad debt expense and accounts receivable. There is no other step. Direct, one shot. Okay. Direct method is not allowed under generally accepted accounting principles, meaning you cannot report that financial statement to outsiders if you're a public company. You must do the allowance for doubtful account. But if you're not a public company, let's say, you have a small business and you don't have any shareholders outside, you can do whatever you like. You can use the direct write-off method. But if you're using generally accepted accounting principles or IFRS to report outside to other external parties, then you must give them the bad news. If you're the owner, you're the operator, you're everything, you know everything, follow. So there's no need for you to report in any particular way. You can do as you like. Which one? This one? This one? This one? So what is the question? It is going to credit to the accounts receivable. No, the debit cannot come without a credit, right? If you debit something, you have to credit something else. So what we're doing in essence, this one was 40 before and this one was 267 before. This is not the direct write-off method. This is allowance method. This is the write-off of uncollectible. This is not the method, right? Follow. So allowance method is also a method of writing off. Allowance writing off method and direct writing off method. Write off meaning you get rid of the accounts receivable. The allowance method has more than one step of doing the write-off. The direct write-off method only has one step. Right? So in both cases, we're writing it off, meaning we are removing that accounts receivable. The writing off means delete the accounts receivable because you're not going to collect it. The allowance method of doing the write-off has these steps. The direct write-off only has one step. Clear? Okay. All right, so we did this. We have, so companies have to estimate the uncollectible accounts, like I said, and then the debit bad debt expense and credit allowance. That's the first step. And then once you know that you're not going to collect, you debit allowance and you credit accounts receivable. So we just did these 3 steps. So these are the 3 steps in the allowance method, right? We did these 3 steps. Now, how do we record the estimation? How do we do the estimation? Here, we have an example. Hampson Furniture has credit sales of 1.2 million, of which 200,000 remains uncollected. The credit manager estimates 12,000 of these sales would prove to be uncollectible. So now, they sold 1.2 million and they have accounts receivable of 200,000. Of this 200,000, they have made an estimate that 12,000 is not going to be collected. So in the allowance method, we debit bad debt expense 12,000, we credit allowance for doubtful accounts 12,000. And we show this on the balance sheet this way, right? 200,000 minus 12,000 equals to 188,000. Okay? Are you following? This is just another example of what we did before. Now, if we are going to now write this off, right? If we're going to write this off, the Vice President of Finance authorizes a write-off of 500 owed by RAW Ware. So now you see this, the way this happens is we had estimated a $12,000 doubtful. So we said a $12,000 amount out of 200,000 is doubtful. After trying to collect from this RA Ware company, the seller has been unsuccessful in collecting. It has been many months and this company is not paying. So the vice president, this has to go through approval. They say, okay, don't try to collect this anymore. Don't send them any more bills. We consider this as write-off. Remove this from accounts receivable. So this has to be specific. When you do the write-off, there is one specific company that you are certain that is not going to pay. When you have allowance, it could be anybody. Out of that 200,000, 12,000 could be anybody. When you do the write-off, you know that this one particular customer or these 5 particular customers are not going to pay. So then you record the allowance for doubtful account debit and accounts receivable credit. Right? You follow? Yes. Yes. Anybody understood what I said? Right? Yes.
So this method is okay because
Right.
so that's okay to do that.
Right. We did an estimation, and remember, moving the item between allowance and accounts receivable does not change the net realizable value. The net realizable value remains the same, right? So when you are sure that one customer is not going to pay, right? You remove that from doubtful to accounts receivable. It's no longer doubtful. You are sure that they're not going to pay. So you remove that from the You reduce that from allowance and you throw it in accounts receivable, right? Is that clear? Okay. Now, the VP was wrong. The company did not have money to pay, so when they had money, they went ahead and paid. So RA company, when they started to have money, they went and paid. When this happens, it can happen. You follow? It can happen when it happens, you reverse the write-off. So you put that back in allowance and you create the accounts receivable back again, and then you debit cash and you credit accounts receivable. So you reverse the first entry of write-off and then you record a normal cash and accounts receivable because you received the amount. Is that clear? It can happen, right? I usually tell a story at this point. I had a friend back in '97 when I was an undergraduate student. He borrowed $200 from me, and I forgot about that. You know, I had a mental write-off. I did not. I was a student at the time. $200 back in '97. It was a lot of money, and as a student, it was even a lot more money. But anyhow, I forgot about it. I never asked him for it. It is gone. 1997. 2008. Okay. Again, I'm a student again. I'm a PhD student this time. And this friend of mine, he lives in a different city now. He calls me and he said, can you give me your address? You remember I borrowed $200 from you back in '97. I did not have money to pay you back, but now I have money, so I want to send you this payment. I could not remember. So he reminded me, he tried, but I could not remember. He said, I trust you. I trust that you are speaking the truth. You did borrow this money, but forget about it. He said, no. I must. And so he insisted, so I gave him an address. To be honest with you, I did need that because I was a student again, so $200 would have helped me as well at that time. So this is like a personal write-off story and then recollection from personal accounts receivable. Anyhow, yeah. So I don't take. It is all about you. It is all about you. This is all about you, right? So I should have perhaps maybe bought something with the $200 and gave it to him, and I said, go and sell it, take the money, and then 10 years later, when you give it back to me, give me the desk that I bought you. Anyhow, estimating the allowance, right, under the percentage of receivable basis, management establishes a percentage relationship between the amount of receivable and expected losses from uncollectible accounts. So this is what I was telling you about, that what is the norm? What is the normal percentage of accounts receivable in your industry? What is the normal percentage of allowance in your industry, in your geographic location? So all of these things are taken into consideration. Maybe you're doing business, for example, you're doing business in multiple different geographic locations, and maybe in particular places corruption is high, and then others. So you have to take this into consideration, that what will be collected and what won't be collected, right? So again, exactly how it is done, this is beyond the scope of our discussion, but there are norms. Now, how do you determine these percentages? Also depends on how old the accounts receivable is. So you see here, this is something that we call aging of accounts receivable. Aging of accounts receivable is the older the accounts receivable gets, the higher the possibility that you're not going to collect it. Okay, so you have here, let's say, the accounts receivable that are less than 30 days. The company says only 2% of those are not going to be collected. If it goes beyond, right? If it is, I'm sorry, not the ones that are not due, right? Not even 1 to 30 days, they are 2%. Those that are within 1 to 30 days, they're 4%. If it goes beyond 30 days, but less than 60 days, 10%, 61 to 90 days, 20%, and over 90 days, 40%. So the total estimated amount is calculated by categorizing the accounts receivable into different categories, 30, 60, 90 days, and then each category has the percentage that you're not going to, and then your total is calculated based on those different category amounts. Right? You follow? Right? We must make it complicated, otherwise we will no longer have jobs. You follow? So, okay. Now let's take a look at this example. Assume that the unadjusted trial balance shows allowance for doubtful accounts of 528. Everyone should know what an unadjusted trial balance is. Yes, you went through the pain of preparing several of them, so you know what an unadjusted trial balance is. It's not a foreign language to you. Okay, very good. Alhamdulillah. This is super. Okay. $528. Prepare the adjusting entry assuming 2,228 is the estimated. So now your unadjusted account shows 528 and you have to make it 2,228. So what is the difference between these two? 1,700. So you have to increase that account from 528 to 2,228. That means you have to add 1,700. Do you follow? Right? So the estimated allowance is 2,228, meaning at the end of the year, the allowance account should be 2,228. It already is 528, so you have to increase it by making entry. The entry is for 1,700. So you add 1,700 to the 528, it will go up to 2,228. So you're able to see these allowance. It was 500 before. We will credit it by 1,700 and it will go to 2,228. And the expense goes to back the expense, the debit goes to back the expense, which is liquidated. You follow? So this is the estimation. Remember, when you are recording the estimate, two accounts are involved. Bad debt expense and doubtful accounts, allowance for doubtful accounts. Accounts receivable is not involved when you're recording an estimation, right? You leave the accounts receivable alone. The accounts receivable is touched in two cases. Either when you receive the payment, or you are sure that you're not going to receive the payment, right? In that case, you move that from the doubtful to the accounts receivable. Is that clear? Okay, so here is another example, right? Here is another example. It says this company has been in business for 5 years, so we have accounts receivable, debit for 30,000, sales revenue credit for 180,000. These are the balances. Allowance 2,000. The bad debt are estimated to be 10% of receivable. Prepare the entry. Now, forget all of this. You see this accounts receivable, 30,000, right? This is the accounts receivable. The question tells you that allowance for doubtful account should be 10% of that. 10% of that. So 10% of 30,000 is 3,000. So you have, this is a bizarre problem. You have a debit in the accounts, allowance for doubtful account, and this is, this, I don't know, I don't understand the authors. Why do they do that? Why do they have to do this? But this is what the author has done. This problem is allowance what is the allowance, the normal balance of the allowance account? Okay, what is the normal balance of the accounts receivable? Normal balance of accounts receivable is debit, right? Which means the normal balance of allowance should be debit, right? But look at what the guy has done. What is the balance of allowance for doubtful account? 2,000 debit, right? I don't know why they did that, but this is the balance that is showing here. You follow? It can happen. It can happen, right? In real life, it can happen. But I don't understand why this example is not at the elementary level when you're just trying to learn. Anyhow, the idea is this account must have a 10% amount of this account receivable. Follow? So this should be 3,000. The end should be 3,000, 10% of this, right? To make this 3,000, what do I have to do here? I have to do 5,000 here. Follow? I have to go 5,000 here. So I have bad debt expense debit 5,000 and allowance for doubtful accounts credit 5,000. Follow? So any difficulty in understanding this? We need to make the ending balance of this 10% of this, right? So it had a debit balance of 2,000. We have to make a credit to this account of 5,000 to make the ending 3,000 credit. You have to make it 3,000. The ending balance should be 3,000 credit. Where does this come from? The 5,000. The 5,000 credit and 2,000 debit results in a 3,000. So this one comes first. You want this. Because you want this, you have to put 5,000. Does that make sense? It's bizarre, but this is how it can happen. In real life, it can happen, and we don't have the luxury of getting into the details, but it can happen. If it does happen, your goal is to make the ending balance whatever the estimate is. Okay, so that's all about accounts receivable. Now we go into notes receivable. The rest of it is just surface information, no deep details like we discussed. A notes receivable is a promissory note. A promissory note means you promise to pay the money that you borrowed with a fixed term, with a fixed contract. The accounts receivable is short term, right? Follow. So if your friend comes to you and says, give me 10 reals, I'll give it back to you after 10 minutes, they just give it to them. There's no writing of anything. If the same friend asks for 100,000 reals, there's going to be some type of contract. You follow? It's some type of contract, right? And as a matter of fact, the biggest, largest ayah of the Quran is about the debt contract. It's one ayah in one page. The whole page is one ayah, right? It's ayah number 282 of Surah Baqarah, and it's 282, right? Ya ayyuhalladhina amanu idza tadayantum bidainin ila ajalin musamman faktubu. Write it down. So this is the contract. The details of it is written down, whether it's individual or company, and there is a term and there is a set amount that is determined. Notes receivable can be created out of accounts receivable. For example, let's say you have a customer, they have an accounts receivable, and they're unable to pay that all in one shot. And you tell them, okay, no problem, you pay slowly, right? You pay over 1 year or 2 years, right? So you remove the accounts receivable and you convert that into a notes receivable. It can happen, okay? You can give somebody more time to pay. So in that case, the entry would be to remove that from notes receivable. I'm sorry, to remove that from accounts receivable and add that to notes receivable. The notes receivable shows up under long-term liabilities unless it is paid within 1 year, unless the notes receivable is going to be paid within 1 year. Now, there is every long-term notes receivable has a portion that is short-term. In other words, even if you gave the company 5 years, in 1 year they're going to pay an amount. Are you following? That amount is the short-term notes receivable of the entire long-term notes receivable, right? So if you give somebody a note for 10,000, and every year they're going to pay 2,000, 2,000 of it is going to be in the current asset, and 8,000 is going to be in the long term, because this 2,000 will be collected in 1 year, right? So every year, right, you'll remove 2,000 is paid off, you'll move another 2,000 from the long term and put it in the short term. So there is always a short term amount of the long term notes receivable that is reported under current assets. Is that clear? Okay. Now, valuation of note receivable is the same methodology, right? The short-term notes receivable at their cash realizable value. So you see, if you have any doubts about the net realizable value of the notes receivable, while it is not common, it's not, because notes receivable is a different beast. Before you give somebody notes receivable, there is a lot of credit checking, right? You just don't give somebody 100,000, but you can give somebody a truck of water, for example, without checking a lot. They may go out of business in a week, right? And you will not get that accounts receivable. If you were as strict in doing accounts receivable as you are with notes receivable, you cannot do business. So you're more flexible with accounts receivable, and that's why there is more doubtful in the accounts receivable. Notes receivable, however, it can happen. It happens that where your customers become bankrupt, or lose their jobs and so forth, and they default. But it's not as bad as the accounts receivable. How do you dispose of notes receivable? The notes receivable may be held to their maturity date, meaning, let's say somebody borrowed 100,000 and they're going to pay back within 5 years, and they make the monthly payments for 60 months and they pay it off. This is called holding it until maturity, paying it until the end. The maker may default and pay must make an adjustment to the account. So the second option is the person does not pay, right? Defaulting is the meaning of default means that the person who borrowed the money, or the company who borrowed the money, is unable to pay. So you can renegotiate. You can renegotiate with the person, extend them more time, or maybe make other arrangements. The third option is the holder speeds up. So instead of over 5 years, you can pay in 3 years or 2 years. Banks don't like it. Why do you not like it? Reduces risk, right? Some notes payables have no other, right? Some banks have a clause in the notes payable that if they pay back early, there's going to be a penalty. Right? So let's say you have a 5-year note and they're paying back in 3 years, right? paid back, if they kept the money for 2 more years, there may have been another $10,000 of interest, right? Because they're paying back within 3 years, they will charge them a $5,000 penalty because you get something out of them. You follow, right? Right? This is a predatory policy. This happens. It is actual practice. It happens. Yeah, and this is the business is not usual here. Alhamdulillah. I mean, there is a lot of flexibility because it's a close community, right? So everybody knows somebody. Everybody knows somebody. I know someone, you know someone. So you have a friend in many different places, right? Just by the virtue of me walking into a bank or anywhere, I will find a student at least. You follow? So I have, more than a couple of thousand students that went through my classes. If I walk into a bank, high chance I will find a student. So all of a sudden now I have exceptions. You follow what I'm saying, right? So it is a small community, and alhamdulillah, it's good. We are able to do business in a more flexible and productive way because we are small and we know each other, so we can trust each other. You follow? So it's good. That's why the business is good. The other one, we are here with 2 different types of disposition of the notes receivable. One is honoring the notes receivable, meaning paying it full. Dishonoring notes receivable is not paying. And what happens, dishonoring notes receivable is, let's say you're unable to pay. So let's say you're a customer who borrowed money from a bank and you're unable to pay. If you don't pay and you don't go to the bank and you don't do anything, just sit there, right? Then you will get one type of treatment. And if you are unable to pay and you go and discuss it with the bank, that this is my situation, right? Can you change something? Can you reduce the monthly amount? Can you increase the time, right? Then negotiation can happen if you have paid until last month, now you are unable. So there's some negotiation, but for 6 months you haven't paid and you haven't spoken to anybody. Now at that point, your account may be frozen. They may have taken money from your account directly, because usually when you borrow money from the bank, also require you to have an account in there, right? So require you to have, so they have some hold on your money as well, right? Okay. So here is the presentation of different types of receivables, right? You have trade accounts and notes receivable, financing receivable, blah, blah, blah. I mean, this is just an example. It is, you can look at it. It's not something that adds much more to what you know. Now, you have accounts receivable, and the accounts receivable is a huge part of the business. If you have accounts receivable and you sell goods on credit, and there are 5 steps of managing this. And the auditors, when they come to audit the company, they look at the accounts receivable, how you handle the accounts receivable, how you have reported the accounts receivable, whether the accounts receivable is accurate or not. So you have to keep very, very clean records of how you do this. The first step is determine to whom to extend credit. If you're going to give somebody the goods or services and you're going to collect later, you have to see whether they have a financial condition which will allow them to pay. They have money in the bank, they have customers that they sell to. You look at all these things before you extend the credit. Then you establish a payment period. So you tell them you pay within 10 days, you pay within 30 days, etc., etc. You establish a payment period. Third, you monitor collections. So you see who has paid, who is more than 30 days old, who's more than 60 days old, who's more than 90 days old, you see this, you monitor the collection. And then you evaluate the liquidity of receivables. The liquidity of receivables means how soon do you collect them, right? How soon do you collect them? Remember, receivables, outstanding receivable turnover and receivable number of days. Remember the ratios. If you sell and you collect within 7 days, right? That is better than if you sell and you collect within 14 days, right? So the less time there is between the debit to accounts receivable and the credit to accounts receivable, the less the time is, the more liquid it is. Number 5, accelerate cash receipts from receivables when necessary. How can you do this? How can you get it earlier? How can you get the receivables earlier? By giving discounts. So you can say, okay, you need more money, you're out of money, you need more cash. You can make an announcement to your customers that whoever paid this week, get another extra 2% discount in addition to 2% discount to oh, so many customers will immediately pay using the 2%. You need the cash, right? If you don't give up this cash and give up the 2% and collect this cash, you might have to get this cash from the bank who will charge you 5%. So by giving up this 2%, this is your own money. You forget something so that you can collect the money because you already gave them the goods and the services. Accounts receivable is after you have done your work. You have provided them with the service, you have provided them with the goods. Okay. Now, 10 minutes, inshallah, we'll finish and we'll take a break. Just a few miscellaneous things left. When you're extending credit, when you're deciding, should I give this customer credit, should this customer buy now and pay later, when you're deciding this, you have a credit policy. You look at how much money they have in the bank, how long they have been in business, what type of products they're selling, how many customers do they have, do they collect on time, because your collection from your customer depends on how well they collect from their customers, right? Follow. So if you're selling food to a restaurant, right? If the customers of the restaurant, there are many customers and they pay on time and all of that, that means they have money to pay you. So all of these are things that you look at. If your credit policy is too strict, then you will lose customers, you will lose sales. If it is too loose, if it is too light, it is not strict at all, then you will have many people who are getting the credit and they will not pay. So you try to be in the middle, and if you can check references, so if it's a new business who you're extending a credit to, or it's a new customer, you can ask them to provide references. So they may get a letter from a bank, they may get a letter from another supplier who they buy from, right? And you can trust that. You establish a payment period. So companies should determine a required payment period and communicate that policy to the customers. The payment period should be consistent with that of competitors. So you are selling, so let's say you sell milk and there are 2 other companies that sell milk. Your payment period of collection should be similar to those other companies. If you're too tight, then you go to other companies, right? Go to the other companies. So you want to be, your payment period should be similar to your competitors. You want to monitor the collections, so companies should prepare an accounts receivable aging, the one that I was referring to, that you saw 30, 60, 90 days. And the longer it is, the longer time, the time is a factor. If it is 30-day-old, 60-day-old, 90-day-old, the longer the time period is, the less chance of collecting. So it helps the manager estimate the timing of the future cash inflows and provides information about the collection experience of the company and identifies problem accounts. So if you do this, you can look at last year's collections and see, okay, how many 60 days did we write off? How many 90 days did we write off last year? How many 30 days did we write off last year? Based on that, you can determine the percentage that this is how much you're probably not going to collect. So if you keep this data, you can always go back to the previous years and see what was actually uncollectible. Because remember, one is allowance for doubtful, and the other one is uncollected. You follow? You are sure that this is not collected. This data can only come after it happened, right? But you can look back to last year's and you can see how many times did that happen last year. This will help you calculate a more realistic output. Oh, a more realistic output. Okay. If you have a big problem in this category, significant risk of not collecting the amount, large amounts, then this should be discussed in the footnote to the financial statements. And again, we did not discuss about the footnotes. Footnotes are extraordinary items that you cannot put on the face of the financial statement. So you discuss them in the footnotes. Okay. Now, the acceleration of cash receipts, the reason for the sale, sometimes what happens, if the company is unable to collect from the customers, even after giving discounts, accounts receivable can be sold. Accounts receivable can be sold. There are experts whose job is to buy accounts receivable and collect accounts receivable. Right? So this is another business. Right? So if you are having a sorry life, then you can get into this business where you go and you force people who don't have money and they're in poor condition to pay the accounts receivable. They buy the accounts receivable for a lesser amount. So the company has $1,000 in accounts receivable. You give them $900 and they get the right of collecting $1,000 from the customer. So this is a sale of the company wants to get 900 now, then 1,000 later, right? Because the company has a life, it wants to do its business of buying and selling. This guy who does not have a life, who's going to pay the company 900 and run after the customer, right? Try to get out $1,000, and if they cannot get 1,000, then they try to get 990. If they cannot get 990, if not 950, 930, if not 930, 905, but something more. You follow what I'm saying?
It has to be more than what you wanted.
Yeah, the net obviously works out for them, otherwise why would they be in this business, right?
So it happened, that's what fund right?
Yeah. Yeah, don't let me get into that. Stay here all night. So look at this. What happens? Look at this entry. The company has a $6,000 accounts receivable. So this $6,000 accounts receivable is going to be in the company's debit, right? 600. This is the $600 accounts receivable. So it sells this, right? It gets 588,000. So whoever's buying, they're paying 588,000, right? And they are buying the right, right? They're buying the right to collect 600,000. So they will get the customer's name, the customer's account number, the customer's phone number, the customer's address, and go after it. Follow? Start calling them, start sending them letters, start sending them letters from the lawyer, saying that if you don't pay, this will happen, that will happen, we'll take this from that from you, try to scare and do whatever tactics they have. I don't know if there is something like this in Canada or not, but in the US, these type of companies right? They abound. Follow. So They come up to the customers and they try to collect the money from them. It's a sorry business, but some people are in this business. Follow? These companies are called, there's a name, let me recall the name. They're called collection agencies. They're called collection agencies, right? Right, so this is the service charge is 2%, right? So this service charge, this is called a factor, it's 2%, it's determined, and again, a factor is a finance company. This is a factor is called a factor because they take a factor, a fraction of that, and they reduce the accounts receivable by that amount, but they go and try to collect the whole amount. Follow? Okay. A couple of more slides. Credit card sales. So what happens when you buy with a credit card? What happens when you buy with a credit card? If you are dealing with a credit card, and you pay the balance of every month. You use a credit card, use 10,000 reals, pay the 10,000, you don't pay the interest. Right? There's still interest in this, right? Because the company that you're buying from is not going to get the entire amount. Why does the credit card company give you points to buy the cash back? Where do you get the cash to give it back to you? They charge the seller. Follow. They charge the seller. Why does the seller get credit card?
Easier for customers. Safer guarantees.
Cash is guaranteed. Right? Cash is guaranteed, isn't it? If I give a 500 real bill, is that not guaranteed? Why do we accept it?
They have policies with the client.
It's because they will lose sales from those customers who use it. They will lose sales from the customers who use credit cards. So they will buy from those companies who accept credit cards because they use credit cards, and the credit card companies give you all sorts of things, miles and cashback and all of these nonsense. So where does that money come from? It comes from the seller, right? How does this happen? So if you buy, right, there are three parties: credit card issuer, Visa, MasterCard; retailer, Lulu, Carrefour, Marks and Spencer; and customer, me and you. The credit card issuer charges a fee to the seller. So let's say you go to the supermarket and you buy 1,000 reals or $1,000 worth of goods. This is what happens. You give them the 1,000, they will recognize the 1,000 as sale. You give them 1,000, and you give the credit card company 1,000 back after 1 month. What happens when the credit card company gives the supermarket? It will not give them 1,000. It will give them 970. And the credit card company has promised to give you $5 or 5 reals from there as cash. Right? So you purchase $1,000 worth of items. The supermarket gets 970. The credit card company gets 30. Right? From that, over a period of 10 years, you will get a free airline ticket. Right? 1 meal for every purchase. You fly first class. So everything is first class now because the next person sitting is way away. Okay, you see the problem? Okay. Now, That is the end of chapter. That is the end of chapter 8. This is our agenda because you wanted to take the exam on 3rd of November instead of 27th of October. So we have the second exam on 3rd of November, which is 2 weeks from today, right? Okay. Next week we'll do chapter 9, and then we have chapter 10 and 7 the following 2 weeks. Now what happened? The university cut the last week of classes. Right? So the final exams are going to begin from the week of November 24th, right? For everybody who's not in this class. For us, we just cannot give up the last day of class. We cannot give it up. Follow what I'm saying? Because the last day of class is your accumulated knowledge in action. So what you're going to learn in the last day of class by doing that contest and having team meetings and negotiations is going to take your knowledge to a different level to follow. So we are going to meet each other. We're going to meet on the 24th of November. So this is an extra class. 24th of November is the week of the final exam because the university has cut the last week of class. Are you following? Are you following? Right? So I'm not asking you if it is okay or not, right? Saying that you have to meet, and there is an official online place, the university website, where you can complain about the instructor if you don't like something, and you're going to go there, right? It saves me work. It definitely saves you work by not coming, but your accumulation of knowledge is more important to me, and because I have worked towards that night, I have built for that night, and I just cannot do it. Okay? So 24th of November, we will have, and then the final exam is on the 1st of December on chapter 7, 8, 9, 10.
I have a question. When is the final grade of courses?
So there is a schedule. The university will publish that schedule. They will give that this is the last day of final exam. This is the last day to submit grades. This is the day when all grades should be online. So the university has a schedule, but it's usually published with the final exam schedule. Like for other classes, undergraduate classes, the university decides the final exam date. Right? For master's classes, it's always on the same night of the week as the course, and the instructor decides either to hold it in the first week or the second week. Is that clear?
The times are the same.
The same. The same. You just have to continue to come to class. Just okay. So I'm going to stop.